lot of people hear SBA 7A have no idea what that means. Let me just kind of put that into some little bite-sized pieces. So what they do is the SBA 7A has some different programs. There's Express and their 7A program, which what they do is they issue a guarantee, either a 50%, 75%, 80%. There's different percents depending on the exact loan program. But what they do is they take those same like risky businesses and say now there's no real estate involved. So we don't have the real estate. We're just looking at some equipment and or purchasing an existing business. And so how do we finance that? What the SBA does is, let's just use, for example, a 75% guarantee. So the SBA will give the bank a 75% guarantee on that loan. And what it is it's a 75% guarantee of the loss. And so if you do a $100,000 loan, and let's say after everything's been foreclosed and liquidated, there was $50,000 worth of recovery. And so the bank is looking at a $50,000 loss, and it had a 75% guarantee on that. Now the SBA will come in, step in and pay 75% of that, which is, why is my brain going blank on the math? It's
$12,500.
So yes, $12,500 will be the loss, but they will cover the addition, the difference.
$37,500.
Yes, that's how much they will cover. So the SBA will write a check for that $37,500 to the bank, and then the bank has that $12,500 loss. And so the SBA program steps in and guarantees a percentage of the loss. Now, if there wasn't a loss, then they don't have to step in and do anything. The bigger the loss, the bigger the check, to the bank. But they do that so that the banks will take on some more risk. It's a risk management tool that they can use.
Yeah. And I could go for hours on how government programs affect all of this. And, there's no such thing as a free lunch. We all pay for these costs. So you might as well use it, right? Like, don't be scared of SBAs is my thought. It's my own personal opinion. If it makes sense, take advantage of it. I think a big misconception though is I'm glad that you clarified that. People think, like private mortgage insurance is kind of same way. SBA loans, like, oh, well, they're going to come in and make the bank whole as long as, the loss isn't too big. Now it's just however much they're going to manage how much the bank can lose, but there's not a scenario in which they say, well, we'll make the bank whole.
Correct.
Right. That's what insurance is for. And, banks are sophisticated. And if they really want to manage their risk against portfolios that way, I'm sure that they can do it with, the capital markets. I don't want to get too complex in that, but there's ways to do that. And that's what we saw a lot of people doing in 08, on the winning side of 08, not the people that lost their shorts, the people that utilized, advanced instruments to manage the risk of their portfolios overall.
Yep.
Okay. How much, revenue does a business need to be producing in order to get one of those, what was it, 7As?
7A loans. So that follows kind of that same 1.25. That one's based on the cash flow.
Okay.
Those ones are typically undersecured. And if they're undersecured, what they do is they look at the individual and they look at the project. So both the business and the individual, and they say, oh my gosh, where is any collateral that we can take? Is it in a car? Is it in the house? Is it in some other equipment? And they'll put a lien on any additional collateral that there is. So for example, you're trying to get a business loan. There is no equity. There's no collateral in this. It's a service-based business, and you have equity in your home. The SBA can take a lien on your home to secure that home as collateral in case there is a loss somewhere. But rather than trying to figure out, yes, where all this collateral is coming from, the reason that they have that, the SBA is, one kind of slogan is, well, they're the lender of last resort. Well, it's not necessarily the lender of last resort. It's the lender of first opportunity.
Yeah.
And so when you need somebody to take a little bit more risk on you, that's why that program's there.
Huge difference between the SBA and the Federal Reserve.
Yeah. Yeah.
Which is, by the way, the actual lender of last resort.
So they're trying to be the lender of first opportunity. So
Ed, help me understand what they really mean by that.
So because you're starting a business, you don't have the cash flow, you don't have the collateral, banks don't want to lend to you. It's just the bottom line truth. That's too hard. That's too much risk for a bank to take on.
Yeah.
There's kind of the saying out there that, oh, a bank will only lend to you and you don't need the money. Well, a bank likes to be proven that they can be paid back.
Yeah.
If they if the borrower can't prove that they can pay the bank back, yeah, the bank's not really going to sign up for that debt.
Well, that's the whole difference between like debt and equity, right? And that's where people like forget when people have to sell shares in their company. Equity financing is oftentimes significantly more expensive than debt, right? Like that, and that's why what's interesting about Shark Tank, which people can learn great lessons from watching this show. Yes, but the cost of capital in a business is significantly higher on the equity side. So if you're let's like just as an example, I haven't looked into this company recently in any specific capacity. Totally an example. Apple, though, just so that people can kind of relate. Which they just bought back a ton of shares. But if they needed more money, which they don't, but if they did, they can go and issue a bond, which is debt. To them, that's like going to the bank and saying, "Hey, we need." For them, they're like, we're going to need $200 million, right? But they're like, hey, we need change for them. Yeah, we need some money to build a plant, run operations, do R&D on this, whatever it is. Or they can go to the market and issue more shares in the company, right? And sell them at X dollars per share when they issue them, and investors buy them, and the company gets that money, and now they can use that money just like if they gotten a loan from the bank and run operations, right? If you intend on going out of business, equity is cheaper, right? Like, oh yeah, because you never have to pay it back. But that's why if you have a really good business, but there is nothing to prove there, they're saying, well, the bank won't lend me money, and you're saying, well, it's because we want it proven. We want to know that if like we don't get this same upside potential that if this goes well and blows up, we make a bunch of money, right? You just have to pay us the money back at whatever, 6 or 7 or 8% interest or whatever it is. Yep. And that's very unappealing. So in order to only have that kind of limited return, they want limited risk. Yep. And so equity financing is when you sell equity in a business, people are looking to say like, yeah, I believe in you and I do believe you. I think this is going to go great. Except I'm not looking for a 6% return. I want equity because I want that 100%. I want this thing to moonshot. I want that. I want this business to absolutely blow up, and then I'm going to go sell my shares.
And that's why they have Shark Tank, is because it's not quite bankable yet, and you need to get the equity. So they're all there for the equity piece.
And that's why you don't see a lot of people saying, so sometimes they come in and they say, well, we'll buy some equity. We'll also issue you some debt or give you a line of credit or something, right? Like they'll be that partner, but there's always that equity component. It's very uncommon that in it, an investor, which a bank is nothing more than a form of an investor, right? Says, yeah, hey, I'll issue you the debt and not take the equity when there's a lot of risk. Yep. So yeah, equity versus debt financing.
Yes. Well, I mean, people bring that up, and it is a good point to bring up in commercial financing, because you have a startup business. You can go get your equity partners and inject capital that way. You can go to the bank and see what you can do that way. The bank, once you've repaid the bank's out of your hair, and that pot of gold ideally fills up. Whereas equity partners are all dipping into that pot of gold. Forever. So that's, yeah.
Yep. You got to buy the equity back at some point if you want. So, there's entire classes on, and I took one in college on basically how a company funds, right? And looking at the cost of equity versus the cost of debt and how companies kind of make that decision. Way different on a huge company scale versus like a little company. But generally speaking, just think about it. Like when you go to the bank and you want a bunch of money, like if you want, in a past life, I worked with a lot of contractors, land surveyors, and excavation companies, right, in the development space. One of those excavation, like a cat excavator, is like hundreds of thousands of dollars. Like people drive around St. George and they see them all over the place. Like that is more expensive than any car you'll ever drive in your life.
Yes.
Right.
Yes.
And and it's some 20-year-old kid out there, pulling the lever, swinging this thing around. It's like hundreds of thousands of dollars. So you can't just go to the bank and say, hey, I know how to operate a machine. grew up doing this, or I've been doing this for years. I know how to operate one, and I know I can go. There's not a shortage of work in St. George to have this type of business. Can you just borrow me $500,000 so I can go buy a new cat and a truck to tow it and whatever, and I'm going to be in business? They're going to go, no way. But what you might be able to find is somebody that says, hey, I believe in you, kid. I'll go in with you. You do all the work. I'll bring some capital. That's an equity partner. Mm-hmm. Now, once you're operating, if everything's going great and you go back to the bank and you say, hey, I have jobs lined up. I have cash coming in. I have more work than I can handle. I have employees. I need to buy another machine. Mm-hmm. The bank is now interested in that conversation.
Correct.
Because they're like, hey, there's something here.
There's proven cash flow. It's more than just, I think this is going to work.